market crash of 1929, also called the Wall Street crash of 1929 or commonly referred to as the Great Crash, was a crash in American stocks that occurred from September to late October in the autumn of 1929. It was the most devastating stock market crash in United States history. It kickstarted the Great Depression, and its effects were felt for many, many years.
What a marvelous age we live in.
I'm V, and welcome back to our series where we discuss stock market crashes in history. We have seen so much downside and volatility in the stock market lately. It really seems everywhere we look, it's nothing but negative in the markets. However, it could be worse. We could be investors in the late 1920s. Investors in the late 1920s were about to get the scare of their lives and endure one of the hardest economic crises to ever hit United States. The decade following World War I, known as the Roaring Twenties, was a time of extreme wealth and excess in the United States. With post-war euphoria sweeping across America, many people decided to venture and move to large cities in hopes of creating a prosperous life for themselves. During this time, the popularity of the stock market was booming, and prices were too. Many people wanted to learn about and become involved with the stock market. This was partly due to the widespread belief that stocks would continue to rise forever, despite the inherent risk of pure speculation, which virtually no one really put much thought into back then. People flooded Wall Street to invest in the booming companies and economy of the 1920s. However, cracks were beginning to emerge in the markets. On March 25, 1929, the Federal Reserve issued a warning that excessive speculation on stocks was getting out of hand. This very public statement by the Federal Reserve caused a minor crash in the markets as investors became spooked. This statement publicly exposed the speculative foundation that the markets were thriving on. Nerves on Wall Street remained high until National City Bank provided $25 million of liquidity to stop the sell-offs within the market. And it worked for a short while. The move by National City Bank brought a temporary halt to the ongoing crisis. However, it was going to take much more than a liquidity bump to save the American economy. And at this point, it was showing red flags everywhere. Automobile sales were down, construction was slow, and the national production of steel was falling off. Even worse, tons of Americans were beginning to accrue large amounts of debt thanks to an ease of access to credit during this time. Despite all of the warning signs, the stock market remained hot, with prices rising in almost an unstoppable fashion until early September of 1929. The Dow Jones gained 20% from June to September during that year. This marked the peak of a 9-year face-ripping bull run in the stock market that saw the Dow Jones value increase tenfold. On September 3, 1929, the Dow would peak at 381.17. Unknown to investors, the decline was about to begin. When it did, it was called the Batson break, and many investors wrote it off as a healthy correction for the markets or a buying opportunity. However, those investors would be proven very wrong. The instability continued. The beginning of a legendary stock market crash, unlike anything we've ever seen before, was unfolding. In mid-October of 1929, the selling really began to intensify. On October 24, 1929, also known as Black Thursday, the stock market lost 11% right after the market opened on unusually high trading volume. Wall Street was in full panic mode, and the trading floor was chaos. This led to an emergency meeting of Wall Street bankers, including executives from Morgan Bank, National City Bank, and Chase National Bank. The meeting served to quickly find a solution to ease the breakout of panic in the markets before things got even worse. The group decided to give the vice president of the exchange, Richard Whitney, the power to act on everyone's behalf. With bankers' resources, Richard Whitney acted quick, placing trades to purchase 25,000 U.S. Steel shares above the current market value. He then proceeded to place multiple buy orders on blue-chip stocks. The high-cost orders did successfully tame the rapid sliding markets in the interim. The Dow Jones also recovered from being down 11% on the day to closing the day only down 2.09%. But just as before, this market save would be short-lived, as the following week on October 28, 1929, would go down in infamy, what we know now as Black Monday. On Black Monday, margin calls became increasingly prominent. Many investors were forced to retreat from the markets due to margin calls, and the Dow Jones would close the day at a record loss of 12.82%. The Wall Street panic was back with a vengeance. The following day, known as Black Tuesday, swept Wall Street with a record of 16 million shares being traded in a single day. Billions of dollars were torn from the markets, wiping out thousands of investors along the way. Investor and Wall Street panic peaked as prices became unpredictable. Believe it or not, some stocks had zero buys at any price. The Dow lost an additional 11.73% that day, marking a 23.05% loss in just 2 trading days. The mayhem prompted financial giants to join with the Rockefeller family to buy massive quantities of stocks to show public investors that they still believed in the markets. But to no avail. Nobody could stop the large decline in prices. On October 30th, the markets had a short-term bounce. This bounce led to a very short relief rally that lasted only a few months. Unfortunately, this rally would fall into a multiple-year slide of the Dow Jones. The Dow Jones bottomed at 41.22 on July 8th in 1932. By the end, this was marking an 89.2% loss, which was the lowest level ever in the 20th century. As a result of the chaos in 1932, the Pecora Commission was established by the U.S. Senate to investigate the crash and identify its key causes. This resulted in the U.S. Congress passing the Glass-Steagall Act, which required a separation between commercial banks and investment banks. Commercial banks administer loans and take deposits, while investment banks underwrite, issue, and distribute stocks, bonds, and other forms of securities. Additional measures were also taken to prevent the pushing of stock prices to unrealistic levels. Measures were also put into place to protect people from over-borrowing with the intention of buying stocks and other securities. Stock markets around the globe began issuing new guidelines to suspend trading in the event of a widespread sell-off. This insane period in the financial markets really shows us the importance of data-driven investing. Irrationality is fundamentally built into the stock market. We've seen it in 1929, we saw it in 1999, we saw it in 2008, and we see it today. As humans, we know history has a way of repeating itself. It's why it is extra important to have the tools to effectively analyze the markets with all of the facts. Our goal here at Pluto is to educate and empower you to make data-driven investment decisions. Head to pluto.fi to get started with your free practice portfolio and get practicing today. Let us know in the comments which crash you'd like us to cover next, and don't forget to like this video and subscribe to the channel so you can get notified when Pluto posts next. V out.